This video is for general educational purposes only and should not be considered financial advice. Always do your own research before making investment decisions. If you've ever opened a stock chart, you've probably wondered why prices often seem to stop at similar levels. A stock falls, then suddenly buyers appear. Months later, it falls back to almost exactly the same price and buyers appear again. Or perhaps the stock keeps rising, only to struggle at almost the same level every time. These aren't coincidences. They're the result of thousands of investors making similar decisions. Some investors believe a certain price represents good value. Others decide it's time to take profits. Those buying and selling decisions create support and resistance. Combined with trends, these are some of the simplest and most useful concepts in technical analysis. By the end of this video, you'll know how to identify them yourself and understand what they may be telling you about a stock. Whenever I open a stock chart, I don't immediately look for indicators or complicated patterns. Instead, I ask myself three simple questions. Is the stock generally moving higher, moving lower, or moving sideways? Only after answering that question do I begin looking for important price levels. That simple process removes much of the noise from a chart. Let's start with the trend. There are only three possibilities. The stock is moving upwards, it's moving downwards, or it's moving sideways. In an uptrend, buyers are gradually pushing prices higher. Each rally reaches a higher high. Each pullback finishes at a higher low. This tells us buyers remain in control. A downtrend is the opposite. Each rally becomes weaker. Each new low falls below the previous one. Sellers are controlling the market. Finally, sometimes neither side is winning. The stock simply moves between two price levels. This is known as a sideways market or trading range. Now let's look at support. Support is simply an area where buyers have previously stepped into the market. Imagine a stock falls from $55 down to $45. At $45, investors decide the shares now represent good value. Buying increases, selling slows. The price begins rising again. That $45 level has become support. Notice I said area rather than an exact price. Support isn't usually a perfect line. It's more like a zone where buyers have repeatedly shown interest. Resistance works in exactly the opposite way. Imagine those same shares rise from $45 back towards $55. Investors who bought earlier may decide to take profits. Others think the shares have become expensive. Selling increases, buying slows. The stock struggles to move higher. That $55 area has become resistance. Again, think of it as a zone, not an exact number. Support and resistance exist because people remember prices. If someone regretted not buying at $45, they may buy when the stock returns there. Someone who bought at $45 and watched the stock reach $55 may happily take profits there. Multiply that behavior by thousands of investors. And these price levels begin appearing on charts over and over again. Markets may change, human behavior rarely does. One of the most interesting things about markets is that support and resistance often swap places. Suppose the stock finally falls below $45. Many investors who bought there are now holding losses. Weeks later, the stock rallies back to $45. Some investors are relieved simply to break even. They sell. The old support now acts as resistance. Exactly the same thing can happen in reverse. When resistance is broken, it often becomes the new support. Beginners often believe that once support or resistance breaks, the market has definitely changed direction. Unfortunately, It isn't that simple. Sometimes prices briefly move above resistance, only to fall back the next day. Other times they dip below support, then recover almost immediately. These are known as false breakouts. Experienced investors often wait for confirmation before making important decisions. Patience can avoid many unnecessary trades. Let's look at a real example using Rocket Lab. Rather than looking at a perfect textbook illustration, this is how support, resistance, and trends appear on an actual stock chart. Between January and May, Rocket Lab was in an overall uptrend. The first thing we notice is that the stock continued making higher highs and higher lows. That tells us buyers were generally in control. Next, we can identify an area where buyers repeatedly stepped in. Each time the price pulled back towards this level, demand increased and the shares moved higher again. This became our support zone. Now look at the opposite side of the chart. Each time the price approached this higher level, sellers became more active and the rally slowed. This formed our resistance zone. Notice that neither level is an exact line. Sometimes the price moves slightly above or below before reversing. That's completely normal. Support and resistance should be viewed as areas rather than precise prices. Eventually, the shares broke above resistance. Instead of immediately falling back, buyers continued supporting the stock. The old resistance now began acting as the new support. This is one of the clearest examples of support becoming resistance, or in this case, resistance becoming support. Rather than predicting exactly what the market would do next, these levels simply helped investors recognize where buying and selling pressure was likely to increase. That's why support and resistance are valuable tools. They don't predict the future. They help us understand the behavior of buyers and sellers. Let's finish with a few mistakes many beginners make. Treating support and resistance as exact prices, ignoring the overall trend, buying simply because price reaches support, selling simply because price reaches resistance, and assuming every breakout will continue. Technical analysis is about improving probabilities, not predicting the future. The more evidence pointing in the same direction, the more confidence investors often have in their decisions. Let's recap. A trend tells us the overall direction of the market. Support is where buyers have previously stepped in. Resistance is where sellers have previously stepped in. Support and resistance are usually zones, not exact prices. Sometimes they swap roles, and no level guarantees what will happen next. Think of these tools as helping you understand market behavior rather than predicting the future. Support, resistance, and trends are among the first skills every technical investor should learn. Once you understand these concepts, stock charts become much easier to interpret. In the next video, we'll continue building these skills as we explore another important part of technical analysis. If you found this video helpful, please like, subscribe, and explore the other investing videos here on Practical Assets. Thanks for watching, and I'll see you in the next video.